So the pandemic, of course, resulted in low oil prices, which restricted investment. And as oil prices have recovered, we're still seeing a very slow return to spending money in the oil patch. And like all other industries, the oil patch is being impacted with supply chain constraints.
Hello, everybody, and welcome to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Andy Lipow, president of Lipow Oil Associates, a consulting firm in Texas. He's been in the oil business for 40 years. Thank you so much, Andy, for joining us today.
Well, thank you very much, Justin, for having me.
Pleasure's all ours. So, I would love to hear more about what is going on in the oil industry today.
Well, the big news is really what's happening with oil prices. And oil prices throughout 2021 have steadily risen as economies around the world have reopened from the pandemic. Oil demand, of course, has recovered, but at the same time, the supply has not recovered as fast as demand, and we're seeing worldwide inventories decline. One of the big reasons that supply has not been recovering as fast is because OPEC Plus has decided to slow down the rate of their restoration of oil production, which they cut by nearly 10 million barrels a day back in 2020. So here we are over the last couple of weeks, seeing oil prices rise to over $80 a barrel, which is double what they had been a year ago. And then the Omicron variant enters the scene, and all of a sudden the market is concerned about a repeat of what we saw in 2020 with a significant decline in demand. And as a result, from $80, we've dropped now to $66 a barrel.
Is there any other time in the last, say, 50 years or so, or you can even extend that out, that reminds you of what we're seeing today in the oil markets?
Well, this is, quite different in the sense that the oil markets have been roiled by a disease, if you will, that's really beyond people's control. Of course, we've developed vaccines, but if we think about what has led to oil price volatility in the past, we've had geopolitical events, say when Iraq invaded Kuwait back in the 1990s. We had an oil embargo back in the 1970s. And then in the recent past, say in 2008 or 2014, it was economic factors going into recessions or financial crises that impacted the oil markets. So this time, the triggering event would be the COVID virus. Of course, that resulted in economies around the world, if you will, shutting down, and that ultimately impacted oil demand and lowered uh, demand such that we all remember in April of 2020 when oil prices finished at a negative value, meaning you had to pay someone to take it off your hands.
And looking back on the year as we come to a close, what do you think some of the defining moments for oil has been?
Well, some of the things that we've seen this year is a surprise with OPEC reacting quite quickly to market conditions. Over the years and over the decades, we'd have an OPEC meeting maybe twice a year. They would look around, assess what the oil market was doing or not doing, and they'd be very reluctant to make any changes. But with the pandemic, they've now decided that they need to be much more proactive, whether it was cutting production back in 2020 or now restoring production in 2021 and going into next year, to actually having monthly meetings. And by the way, they're having a monthly meeting today and tomorrow to decide what should be their plan for January of next year.
The people who are keeping an eye on this meeting, what are the possible outcomes that they foresee?
Well, because oil prices have fallen so much in the last week or so, at the same time that the United States, as well as other countries, Korea, Japan, the United Kingdom, are going to release some of their strategic petroleum reserves, I think that OPEC is now going to decide to postpone the increase in oil production that they were going to restore in January because they're now fearful of creating another oversupply situation, which will just depress oil prices, which each of these OPEC plus nations need to balance their domestic budgets.
Would you call this time unprecedented, generally speaking?
Well, it's unprecedented in what the cause was, but clearly we've seen oil market volatility over the decades, with big swings in the market. But if we were to just to confine ourselves to what's been happening in the last week or 10 days, the volatility in the oil market up and down has really been extreme with a $10 move to the downside, then moves $5 a barrel to the upside. It's very rare that we can come in and say, oh, we're already $4 a barrel off the high for today, and the oil market is still trading green or positive up on the day. So we're seeing a significant amount of reaction. We also know that over the years, more and more people have gotten involved in the oil market, whether it's the oil majors or producers or private equity, hedge funds to exchange traded funds such as the USO Oil Fund and many others that we saw entering the market in Asia.
Has monetary policy had any effect on the oil markets over the last 18 months?
Well, I think the context would be that, the monetary policy has put a lot of cash into the market. I mean, it sustained a lot of people through the pandemic. People had money to spend, they've spent that money. Well, when you're spending money, you start creating demand for goods and services. Those goods and services are going to be delivered, whether it's cargo ship into the United States, airlines, cargo in that respect, or then trucking it from the distribution points to the homeowner, all have helped to increase demand for diesel, especially. Of course, jet fuel demand is lagging with international travel. But the bottom line is that as we've contributed, if you will, more cash into the market, that has ultimately impacted not only oil prices, but other commodity prices because we've seen a burst in demand.
How has all of this affected suppliers?
Well, if we're thinking about suppliers on the production side, one thing that has happened is they've really been more circumspect about drilling more wells because if we were to look back to January of 2020 when oil prices were around $60 to $65 a barrel, we were producing record amounts of oil in excess of 13 million barrels a day in the United States. But the producers weren't making any money and the investors are now demanding a return of the capital that they've invested. So the pandemic, of course, resulted in low oil prices, which restricted investment. And as oil prices have recovered, we're still seeing a very slow return to spending money in the oil patch. And like all other industries, the oil patch is being impacted with supply chain constraints. And the one that I like to point to is truck drivers. Truck drivers are needed in the oil patch to either haul the oil away from the rig to a gathering point. They're used to haul chemicals into the drilling site. They're used to haul water away from the drilling site. So if you have a restriction in the truck driver availability, of course, that's going to impact on the drilling costs. And you think about all the steel that's going into drilling or drill pipe. The cost of that has gone up, labor has gone up. So we're seeing a slow return to drilling, whether it's in the Permian Basin or the Bakken in North Dakota or other fields here in the United States.
What role does the U.S. have playing forward in oil output? For instance, I think under Trump presidency, there was a lot of kind of lay talk about how um, he had managed America's oil supplies in a intelligent manner, and then therefore, if things were to change, that would potentially be negative for the U.S., especially energy prices generally. So, What role does the U.S. have to play, and like what role have we played? Will that change?
Well, if we put this into some context, over 10 years ago, the US was only producing 5 million barrels a day of oil. And prior to the pandemic, we were producing over 13 million barrels a day. So the amount of our imports went way down. And the US became a major supplier of crude oil. We were exporting in excess of 3 million barrels a day. That was more than most of the countries in OPEC. And what it allowed us to do is change our view on foreign policy. We were no longer reliant on the Middle East for their oil supplies. The rest of the world was. As the US develops more and more energy supplies, whether that's oil, natural gas, wind, and solar, that allows us to be less dependent on the rest of the world. And therefore, we're not so worried anymore about what happens, say, in the Persian Gulf or elsewhere. And that has been a very good thing for the US. Of course, as our oil production goes down, if demand doesn't go down commensurately, we once again become dependent on other places in the world.
Do you see that happening?
Well, we're seeing in the United States a decline in oil production. Some of the reasons I've already outlined due to a lack of investment, but some of the reasons are due to government policies, where there's a limitation, if you will, on the number of drilling permits that they may issue in the Permian Basin, or whether we're going to be drilling in the Arctic National Reserve up in Alaska, or are we going to be drilling in the Gulf of Mexico? And that loss in oil supply is looked to be made up with renewable fuels, whether it's ethanol or renewable diesel or sustainable fuel or electric vehicles. And we do see, Tesla as well as the major auto manufacturers making a big push into electric vehicles, which of course will result in lower gasoline demand here.
I mean, the implications of the U.S. supplying oil to the world seem to be massive. I mean, do you recognize that? Do you feel the same way?
Well, I do. I mean, I see how we're able to change our foreign policy to take a more robust look at what's happening around the world without the worry in the back of our mind that, oh, perhaps oil supplies are going to be constrained and that would impact the domestic economy, ultimately throwing people out of work. So those kind of concerns get put to the side the greater our energy independence is from other locations that, number one, are geopolitically unstable, and number two, have a fair amount of internal violence that really the American public has no interest in getting involved in.
Tier 1 Silver is an exploration company focused on creating value for shareholders and stakeholders through discovery of world-class silver, gold, and base metal deposits in Peru. Tier 1 Silver trades as TSLV on the Toronto Venture Exchange. It just hit its first high-grade silver drill intercept, its Curabaya project. The company believes they're on the cusp of a massive silver discovery, and they're currently expanding their permitting to aggressively pursue multiple targets that have been identified on the property. For more information, visit tier1silver.com.
The news out of the oil industry today are eye-grabbing, to say the least. Like, for instance, in CNBC today, they published an article titled "Oil May Hit $150 and a Surge Could Definitely Escalate an Inflation Scare," says analyst Christopher Wood from Jefferies. So he says, he writes, quote, Wood, "In a world that really reopens, which is a big if, the oil price can go significantly higher. Oil got to over $80 with a lot of Asia closed," he wrote. "In a really fully reopened world, the oil price could go to $150 because the supply constraints are dramatic." Do you share that view?
Well, I don't, but what I would agree with is that the supply side of the equation is what people are looking at, because we know quite well what can happen here in the United States with shale oil production and where it is today. What is really unclear, if you will, is what is the spare capacity in Saudi Arabia, Kuwait, the United Arab Emirates? And if oil demand were to continue to grow, another 3 to 7 million barrels a day in the next year, where would all that oil come from? But at the same time, now don't forget, the United States has imposed sanctions on Iran. We've imposed sanctions on Venezuela. And between the two of them, probably nearly 3 million barrels a day of oil is off the market. That's a decision we've chosen to take, but one could see that there is oil out there. The other thing that I would say is we have a number of other things that are happening. One is as oil prices go to $100 a barrel, 120, 150, you will get some significant demand destruction because it will, number one, impact economies around the world, slow them down. And the consumer at $4 a gallon gasoline here in the US starts to conserve. So that's one thing that's happening. Another big item that we're seeing in the oil industry that doesn't get as much press as crude oil is what's happening on the natural gas prices. Here in the United States, our natural gas prices are between $4 and $5 a million BTUs. When we think about what is the price in Asia or in Europe, it's 5 to 7 times that. They're paying $30 to $40 a million BTUs. And if we were to convert that into an oil equivalent basis, it means $200 to $250 a barrel. Well, when you're faced with that type of choice overseas, you start switching from natural gas over to oil. And of course, that has thrown another wild card into the system as we go through this winter, as utilities and factories overseas switch their energy source to oil. And that, of course, has created additional demand.
There's a lot of fear drummed up around winter. Do you share that fear, particularly as it pertains to energy prices as we head into the winter months?
Well, I'd certainly be concerned on the natural gas price because when we look at inventories in Europe, they're down at around 70% of their capacity. So that's the low end of the range. The United States is connected to the rest of the world on the natural gas side through our exports of liquefied natural gas off the Gulf Coast. So it would concern our supplies if Europe and Asia started drawing even more natural gas out of the US and impacting inventories here. I think the greatest fear is what happens if you get a sustained cold snap for 1 or 2 weeks. Is the system then simply unable to deliver the amount of natural gas to the consumer that they require? And then do you have, uh, cutbacks? Or in Europe, they're worried about rolling outages for a couple hours a day on power generation. That would be my greatest fear. And as we experienced here in Texas in February during the freeze, whether it was natural gas producers, wind, or solar, they all were impacted by the freeze. And as a result, we had widespread outages here in Texas. So you would be worried about another extreme weather event impacting the grid and ultimately impacting energy prices.
In another headline published by Yahoo Finance, oil prices have tanked so hard, traders are assuming planes won't fly for 3 months. According to Goldman Sachs, reads the article, of course. Oil prices have come down way too fast on Omicron variant concern, says a Goldman Sachs oil strategist, Damian Corvalin. The lack of discretionary buying activity in the face of an uncertain new COVID variant has therefore left prices in free fall and pricing in a dire demand outlook. We estimate, based on our pricing model, that the market has now priced in a mammoth C.7 M millions of barrels per day negative demand hit over the next 3 months with no offsetting OPEC plus response, pointed out the researcher on Wednesday. What do you think about that?
Well, the first thing that I would point out is the comparison that they were making about jets not flying. The context is as follows. If demand declined 7 million barrels a day, it turns out that worldwide jet fuel demand is 7 million barrels a day. And they were just trying to draw the parallel of, if we were to try to think about what the demand destruction is, it's equivalent to grounding all those jets. But they're certainly not implying that jets are not going to fly. It's just the magnitude of the demand destruction. Now, the market is pricing in a significant demand destruction, and I agree with them with that. And I do agree that the market is overdone to the downside. But when you start seeing the reaction from governments around the world that a variant has been identified in South Africa, we can't say that it emanated from there. We know it's identified. It's now in 20 odd countries. So it could have come from somewhere else. We simply don't know that. But the reaction of the world, if you will, has been swift. And what the market is concerned about is when you see this swift reaction and the banning, if you will, of foreign nationals from Southern Africa into Europe or the US, you leap to the conclusion that not only is jet fuel demand going to start declining, but there's a chance we're going to have additional lockdowns throughout the OECD. People are going to be working from home again, and we will have a significant decline in demand. And it does feel, when I look at the news, that there is almost a sense of panic in the politician's voice because they're just trying to show that they're doing something to protect the public in an environment really where the Omicron virus, I suspect, is in not 20 countries, but in 50 countries. It just hasn't been found yet.
So as we speak on CNBC, there's breaking news that California has confirmed its first Omicron case. The other breaking news is that the Dow has given up 500-point gain as CDC confirms the first Omicron case in the US. Now, you've touched on this a bit, but where could this possibly play out if things go south and we do head towards further lockdowns?
Well, you certainly could see oil prices fall below $60 a barrel. That would be pretty clear because the market reaction is going to be quite negative. You're going to generate a huge amount of selling, because people just want to get out. They keep thinking about oil prices went to zero last year. So why do I want to hang around at $66 a barrel or even $60 a barrel? I think the issue is you have to try to handicap, are we going to lock down the United States again? Or are we just now going to take the tact, we'll do what we can to protect the healthcare system. If it wasn't Delta and it wasn't Omicron, are we going to have the Sigma variant, the Zeta variant, a Gamma variant? And is this just going to become something we have to learn to live with? And we just simply can't shut down economies around the world every 6 months. I think that's the crossroads that we're coming to politically wise and public wise, that people would say, well, if there's another variant and we have to wait for a vaccine that might be 3 or 4 months away, they may begin to feel that, government is not up to the task. I would say we should be impressed that a vaccine did appear on the market within a year. That was a hugely compressed time frame. I have no doubt that we can develop additional vaccines for new strains that come out. I think the biggest issue is, can you really afford to be starting up and shutting down economies around the world every 6 months or every 8 months, every time some new variant appears, and we don't know ultimately whether it's going to be impactful or not?
The cascading effects of locking down nations, economically speaking, is now demonstrative. Whereas maybe in March 2020, it was more theoretical for most people, that is. Now it's demonstrably impactful on the people's lives and abilities to even put food on their tables. And I'm not sure if a wide swath of the United States is interested in another lockdown.
I would agree with you. I mean, I just don't think that the public would stand for it. I think, you might have, mandates from the government, but, here I am in Texas. I think the governor would say, we're going to continue on with business as usual. And I just think the public around the country is going to start looking at this saying, well, what you did before didn't work because here's another variant.
Can the flyover states, continue business as usual, even if, say, the coastal states maybe do a lockdown? And what I mean by that is, what impact would that have on the economy if you've got flyover states that are mostly open and coastal states that are shut down once more this winter? What impact would that have on markets or oil specifically?
Well, on oil specifically, it certainly would be a bearish because the coastal states, such as California, they consume roughly 10% of the gasoline demand in the country. So you could see there's no doubt that shutting down half the country has a big negative impact on the oil markets. But you would now have this bifurcated country, even worse than we've seen before, with parts of it open, parts of it closed. I think what you would see over time is additional migration to states like Florida and Texas. Whether you agree with them politically or not, those who do are going to move from, high tax states like California and New York, saying we've had enough.
We've had the honor of sitting down today with Andy Lipow, president of Lipow Oil Associates, a consulting firm in Texas. Thank you so much, Andy, for joining us today.
Well, thank you very much, Justin, for having me. I appreciate the time.
And thank you, everyone, for listening.